Good afternoon, everybody. As you can see, we are reporting to you today live following Hurricane Sally, which really did a number on us here in the Florida Panhandle. But we've got Suzanne, Andrew, and Glenn here with us again today for another great PPP webinar for you. My name is Jamie Terrell. I lead marketing and communications here at Saltmarsh. We're happy to have you here with us for part 7 of our now ongoing PPP series. I am reporting, as you can see, live from my husband's pickup truck today, as many of us are still without power, and I know Suzanne is working on getting her connection restored for us today as well. We know that, oh, here we go. So with that said, I think it's safe to say that really nothing's going to stop you from getting these webinars at this point. We're going to try to proceed with as little technical trouble as possible, but know that if we do encounter any issues, we'll make sure to get these materials to you alternatively if we need to. We also want to acknowledge so many of our clients and friends in the Alabama and Florida Panhandle area, including many of our own Saltmarsh family and firm who would typically be here with us, but instead are dealing with the direct impacts of the storm. Our hearts are with you all as we begin the rebuilding process. And so, we definitely want to be thinking of all of them. If you're a regular guest of our weekly webinars, we appreciate you being back here with us. And if you're here with us for the first time, we want to welcome you as well. If you've missed any of our previous webinars, including those on PPP, you can always find them on our COVID Resource Hub, which you'll see showing here on the screen. There's access to that page and also an email, which you're welcome to contact if you have any questions. Here with us again today are 3 members of our COVID recovery and response team: Suzanne Cox, Glenn Scharf, and Andrew Kent, all shareholders here at Saltmarsh, and we're happy to have them leading our presentation today. Before we begin, I do have a few quick housekeeping notes to mention. First, everyone on the line has been muted. If you have any questions during the webinar, you're welcome to share them with me in the chat. Glenn, I believe, will be manning the questions with me as well. And so if we have time for questions toward the end, we will certainly address some of them together. You're also welcome, of course, to share your questions with us via email to ppp@saltmarshcpa.com, and someone from our team will follow up with you directly. Our presentation is being recorded, God willing, and you will receive it very soon in our follow-up materials, and so we'll make sure that you get that as well. With that, I'm going to make sure that we are good to get started, and if we need to make any adjustments to our setup real quickly here with you, we'll go ahead and do that before we get started. And I would say, Andrew, Suzanne, Glenn, y'all can all unmute yourselves. We'll kind of see how our audio is looking now.
All right. Yeah. Can you guys see the screen?
Yep.
Yep.
No, you got it.
Yes.
We can see you.
Woo! All right. So, like Jimmy said, we're having some last-minute technical problems. I'm supposed to have power in Tampa, but I just lost it and was scrambling to get it back up. So this is pretty much on par for the course, though, for everything lately. So hopefully I will be good to go here. So I kind of missed a little bit of the intro. Welcome back, guys. This is part 7. We're starting to lose track, to be honest. It's still 2020, they tell me. So here we are, and we're still getting a pretty good response amount of people that want to come here about PPP. So we're going to keep having these until so we get less people wanting to know about PPP. Like Jamie said, a lot of our viewers are having trouble right now with hurricane issues, and so we still are going to run, and these are recorded, so hopefully you all can catch the recording or part 8, which will be in a couple of weeks. So today's agenda, we're going to go over some of the new guidance. There was one IFR issued since our last webinar, so we'll talk about a little bit of the changes there. Common concerns, we're getting a lot of concerns from our clients, our bankers, just everyone is asking us, certain questions. So we're going to go over some of those questions. One of those questions is an FTE reduction scenario. So whether you want to go 8 weeks or 24 weeks, what are the pitfalls there? So we're going to walk through that. And then really hot topic right now, although it doesn't have to do with PPP necessarily, we are going to go through the latest legislation on payroll taxes and answer some questions there. That's been really hot. We're getting a lot of questions, although not, again, PPP related. It is a current issue that we're dealing with. So we're going to cover a little bit of that. So you can see felonious brew over here. Please follow the instructions. No crying, no whining, no laughing, no sneezing, farting, burping. None of that is acceptable today. So we just want your serious face for this webinar. All right, so some new guidance. A lot of questions surrounding related party stuff. From the get-go, there has been a lot of questions about related party items. And so one thing that they did clarify is that rent payments to a related party are only eligible if, now this is important, so look alive here. First of all, of course, you know, number 2 is that the lease had to be in place prior to February 2nd, 2020. But then the most important item, which has changed, is number 1. And so the rent payments that are forgivable cannot exceed the amount of mortgage interest that is owed on the property during the covered period. So that severely limits, in most cases, the amount of rent that will be forgivable under the PPP loan. So keep that in mind if your rent payments are to a related party and it's yourself, most likely in a different company or something like that. You need to check how much the interest is on that note. And if, let's say, you don't have a mortgage on that piece of property, that means you get to forgive this much. So this is an important change. So this just adds another complexity to your application and your calculation. So just keep that in mind if you are going to be trying to deduct, to use rent and get rent forgiven, that if it is a related party rent, you'll need to pay attention to this one. So that was a new piece of guidance. Some of the other pieces of guidance have to do, of course, again, with related parties, because that was a hot topic from the beginning. And if you're watching the news, there's a lot of discussion about fraud and things like that. And most of them are surrounding related party activity. So hence why they added some new guidance for related party transactions.
Suzanne,
so, yes.
I'm just going to add, before you get too far on related party rent, everybody should just keep in mind too that the SBA's rules on affiliation are very broad. And so, you really will need to be careful when you're looking at, it's not as simple as I'm just paying rent to myself or I'm paying rent to another corporation that I directly own. Sometimes you have to really delve into those affiliation rules to determine if you're related or not. But anyway, just want to point that out.
From our resident attorney. That's a good point, though. Thanks for bringing that up. So the other thing is, if you do have mortgage interest with a related party, so if you are a related party that's holding the mortgage, you cannot get forgiven for that interest. So if you have a related party holding the mortgage and you're paying interest on a mortgage with a related party, you cannot use that interest. So remember, that's part of the other costs. So this is outside of payroll. You're allowed to deduct interest, utilities, rent, things like this. Interest with a related party is not eligible. So second item here, owner employees. That's another area we're getting a lot of questions on. And if you guys remember from prior webinars, there is some tax on owner employee payroll. So one of them is the $20,833 for the 8-week, and the other one is $46,154 or 153, excuse me, on the 24-week. And so they put in the new guidance that this only applies to owners greater than 5%. So if you have some small, 1 or 2% owners, they are not going to be hit with that cap for their salary. So just keep that in mind again when you're filing your applications and you're computing any reductions, that any owner employees with less than 5% are excluded from that cap. Okay, if you sublease space, these ones kind of make sense if you're just reading it from a practical standpoint, but they did actually come out and state these. So if you sublease a space, you can only be forgiven for your piece, but not your sublet piece. So if you have a lease and you moved out and you actually sublet the entire lease, you do not get to count that. Again, makes sense, but they did define that. The next one also kind of makes sense. If you own a building and you own or occupy part of it and you lease out another part, so you own a building and say you use 50% of it and then you rent out the other 50%, you can only take the interest on the percentage of space that you own or occupy. And same thing with rent, like we talked about. So if you own that building and you're paying interest, you've got to do the math. So you've got to say, okay, I have 50% of this space. I only get to get 50% of the interest. Same thing on the last bullet here. If you work from home, you obviously can only take the share of the covered expenses that were deductible on your prior year's tax return, or 2019 tax filing, excuse me. So just again, be careful if you're a sole proprietor and you're working from your home, that you pay attention to this new guidance here. Anything to add, Andrew or Glenn?
No, I'll just add that, I mean, these issues, these affiliated party issues, and these are impacting a lot of our clients, because a lot of them are small business people that, you know, rent from an affiliated entity, or, you know, have owner occupied properties. So this is these are new guidance. They answer some questions. I know the owner employee thing had come up a number of times with regards to ESOPs, and whether, you know, employees that owned through an ESOP, or, you know, whether their salaries were subject to these complements. So this new guidance answers some of those questions for us.
Yeah, but you know, one thing to note, and we'll talk about this a little bit later, is that, you know, if you go out to 24 weeks, the likelihood of needing those types of expenses become less and less. So, you know, just kind of be mindful of, you know, where the expenses are coming from and how long your period is. You know, so once again, it's kind of one of those no rush to file kind of reasons, if you do have some rent that's in your calculation right now.
So guys, I did hear from someone that I'm a little choppy, and I think when my computer rebooted, it picked up the wrong audio source. So just in case no one can hear me, because I'm getting text messages that I am choppy. So Glenn or Andy, if you guys could pick up this slide, and I'll see if I can work out my audio problem.
Suzanne, I can pick this one up, and Glenn,
Great,
feel
thank
free
you.
to chip in. So you know, one big question we're getting, and one thing we're seeing a lot from our, you know, our lender clients and friends, and we're getting questions from clients, and people are getting advice on this. And this represents kind of a change for us, which is that if you know, as the forgiveness process drags out, and as more and more of you are, you know, you're still waiting to file because your bank hasn't opened their portal or whatever, we've kind of shifted our recommendation to that, you know, if you can hit your forgiveness with your payroll cost alone, we're recommending clients do that. All the related party stuff that we just talked about, having to make related party interest calculations, what we're finding is the payroll is relatively easy to calculate. Most of our clients have good payroll reports, and they have those documents. They're well organized there. Where they're struggling is pulling all the utilities in, you know, pulling the rent and the mortgage interest and those costs in. And, you know, back when we were all stuck in an 8-week period, it was really important to calculate those, because theoretically you couldn't get full forgiveness unless you included all or some portion of your rent or mortgage interest or utilities. But with the 24-week covered period, it's, you know, virtually every borrower is going to be able to achieve full forgiveness with payroll alone. And so for a lot of clients, we're recommending to streamline the process. Just focus on your payroll docs, focus on getting that right, use those to support your loan application. And we're seeing borrowers come down the same path. We're seeing AICPA, I think, you know, saying something along the same line. So there's just something to consider as you move forward. If you haven't filed for forgiveness yet and you're struggling to gather all this additional documentation, you know, it may be that the simplest thing to do is just focus on payroll alone, and you're going to get to where you need to go. I mean, Glenn?
Yeah, I mean, it's, you know, we've talked about that all along, is that doesn't matter, you know, whether your payroll costs are larger than the amount of your loan, they're still eligible costs within the covered period. And that's kind of what we're talking about here, is that if your covered period, which most people are using 24 weeks now, you should be able to cover everything through with payroll, unless you've got a shutdown or something like that that's been significant. But there's safe harbors in order to get forgiveness, even if you are shut down. So you really got to be mindful of the calculations at the end, and make sure you have all the right costs in there.
Right. I mean, and this is something that Glenn and Suzanne have accused me of being belt and suspenders for the last 2 or 3 months, because I was an advocate of well, include everything. But I think given the stretching out of the forgiveness period for most people, given the fact that most of our clients still haven't been able to file yet, it makes sense to if you've got a significant amount of payroll costs that you've accumulated now that falls in those forgiveness buckets, it's a lot simpler to do the calculation just based on payroll alone.
Okay, Suzanne, we lost the slides.
I know. I am on it. I should be good. I had to reset my PowerPoint, so we are back in business, guys.
All right.
All right. Is my audio better at all?
Yes.
Can anyone tell? Okay. I think I successfully changed it from my computer to my camera. So thanks again for everybody that texted me. We do not want bad audio. So this is a repeat again of some prior information, but just need to keep repeating it because it is an important area. We're getting a lot of questions. Bank portals, we'll get to this a little bit later as well, but haven't opened, and the SBA has yet to review an application or determine a forgiveness on an application. We've not heard of any forgiveness happening as of yet. And so just a reminder that once you do file the application, the lender has 60 days, and then SBA's got 90 days. And so, as I'm sure you remember also, is loans over $2 million are going to be audited, and then any loans under $2 million, there'll be a random selection of audits. And so, sort of a roulette wheel process. And so just be advised, if you're above 2 million, to make sure that you have all your documentation and everything ready for that audit. We're expecting, obviously based on the timeline as of right now, a lot of bank portals aren't even open yet. So we're expecting this to go into 2021. So everything we've talked about before, as far as, checking with your covenants, checking with your bank, making sure that you understand the implications of this moving into 2021, just make sure you're aware of all of that, so there's no surprises come year end, because we doubt that this will be resolved and everybody's going to have a forgiveness by 12/31 2020. So keep that timeline in mind. We are hearing some are advising just wait for the new guidance to come out, and just hang on. We agree that you don't need to freak out or worry or anything like that. There is a lot of time. You have 10 months from the end of your covered period to apply. So there is not a rush. So it just depends on if you're of the camp that, hey, I'd rather get this over with, or hey, I'd rather wait. Our collective opinion, maybe as a group here, is that we probably won't get guidance until after the election. We don't know that, so that's not a factor or anything, but this is our feeling that we probably won't get any new guidance until after the election. So take that for what you want. So some of the possible negative alternatives, if you file with SBA, what could happen possibly. We have some clients that fell into this camp when they filed quickly, and maybe they filed for more than they were supposed to get, and so they got too much money, and so there's really no guidance yet on exactly what's going to happen. So do they just leave that part as unforgiven, or when do you pay it back? Most of the banks right now are saying don't pay it back yet, wait till we get guidance. And so there's a lot of questions still surrounding that. We don't have final guidance. And anything else there, guys?
I was just gonna, Suzanne, I was just gonna say that this whole question about audits and the auditing of loans over $2 million, it kind of goes back to the previous slide about what to include. You know, one benefit as we continue to, you know, if you're stuck in this 24-week period and you can't file yet because your bank isn't, you know, their portal isn't open or whatever, well, just relying and focusing on getting your payroll records right, having them well organized and focused, that should make any audit process down the road a lot simpler, you know, rather than, because you're really only having the auditor look at one set of documents and they're all going to be in the same format. They're all going to be focused on payroll versus, you know, having copies of power bills and copies of trash bills and copies of your rent statement that you've got prorated calculations.
But no fuel, don't forget, no fuel.
No fuel. But yeah, I mean, that's, you know, so that goes kind of back to that previous slide. You know, the simplifying your application, keeping it as simple as possible will probably help you when you get to the, you know, the SBA review piece.
Yeah. So one of the other big questions that we've been having, I'm going to pass it over to Glenn, is on, you know, what are the tax implications of this rolling into 2021?
Yeah, so, you know, tax implications are really up in the air right now as far as, you know, people's opinions. You know, so let's talk about where we are with everything, and what, you know, what you can do to kind of prepare for, you know, next year in filing taxes. So the income can be excluded, but your deductions are also excluded as well. So it's a wash, but it won't feel like it. And I'll show you in just a minute through a little calculation that I have. So if you know, but the key thing is that, you know, people are saying, oh, well, when do I got my tax return? When do I file? These things are going to go, you know, I may not get forgiveness until, you know, if I wait 10 months, I might not get forgiveness until next June. You know, so there's no rush to file. I would plan on extending your return. I would not file a return until you get your forgiveness letter saying that everything is forgiven, or a portion of it is forgiven, and so forth. So I really can't emphasize enough to extend your return. I know a lot of people out there don't like extending returns, but let me tell you, there is no, you know, you're not going to get, you know, special favorite, or you're not going to fall into a separate bucket as far as, you know, are you going to be audited because you extend? None of that is true. You know, that is all, you know, most of 99% of audits are random, or whether you're a large corp, which is, you know, a publicly traded company, and you're on constant audit. So, you know, it's not gonna, you know, so don't fear that for any reason of, you know, rushing your, you know, CPA to go and file your return. We're personally, I mean, certainly if every one of our clients filed an extension, then it'd make our lives easier a lot in March and April, but man, this time of year would be a nightmare for us. So as we found out with the delay, just in general from April to July. So, but look, you know, that's the approach that you should take, is just patience, patience, patience. And then finally, you know, typically if you've never had a debt forgiven, you know, the person that's forgiving the debt, you know, gives you a 1099-C. Well, from what we're hearing from our banker friends is that the debt is not forgiven, it's just being paid by the SBA. So they say that they're not expecting to issue 1099-Cs to everyone. But I would imagine just an acknowledgement letter saying that, you know, this, you know, money was forgiven, etc., is going to be your only documentation as far as that's concerned. So now I'd like to talk a little bit about this. It's a wash, but it won't feel like it kind of thing that I was just talking about.
Hey, Glenn, just before you go there, I mean, but this has implications, especially for closely held businesses that issue K-1s that are pass-through entities. I mean, when you start talking about extending the corporate return, you're also going to extend all your owner returns as well, right?
That's right. I'm talking about, yeah, if you've got an S corp or partnership, we're talking about, you know, filing your individual extensions as well until, you know, you get, you know, this full forgiveness. So, you know, once again, you know, this goes back to also, you know, calculating, okay, what is my tax going to be in April? You know, and, you know, the next segue here is kind of looking at those situations. So this slide here is is about as confusing as this little minion. I think this is Bob, isn't it?
That is Bob.
Yeah, that's Bob. So, just looking at it from a perspective of numbers, the PPP loan in this situation is $30,000. In 2019, your income was $400,000, your payroll is $250,000, so your net income was $150,000. So your taxable income is $150,000. So in this example, we're assuming that your business did not have any, no effect, no decline. So, if you were, in a service business, you picked up other services, you were able to grow in certain areas, things like that. So if you had the same income, you had the same payroll, your net income is $150,000, but now you got this PPP loan that you paid $30,000 of this $150,000 or the $250,000 of your payroll. So your taxable income is going to be $180,000. And so from this perspective, it looks like this money is being taxed when in essence it's not. And we'll see on the next slide when you go to in this next slide, you see that 2020 income now has dropped 30,000. So, you still paid your people because, you needed to. So your net income was really down 120,000, but you did get $30,000 to pay these PPP loans. So we add that $30,000 back, and then your revised taxable income gets back to the 150,000, just like if you had not had the PPP loan at all, and your income was the same as 2019. So this brings up the discussion of, well, if my loan doesn't get forgiven until 2021, do these deductions become unallowable in 2020 or 2021? That's a debate that we have heard from many CPAs. We just attended a webinar that was given by the AICPA, and some were suggesting that we push the disallowed PPP expenses out into 2021. I don't really see that happening. There's no legislation that's telling us what to do and when to do it. Certainly from an accrual standpoint, if you have filed the application, if you are reasonably certain that you meet all the requirements of the PPP forgiveness process, then you really have to probably take these disallowed deductions in 2020. The other thing is that it may be more beneficial to take them in 2020 because your income may be lower, and you're not going to have as big a tax hit. So you kind of, we'll have to wait and see how this plays out to see if there's any guidance from the IRS and really where we're going to go with this. But for now, I would plan on, and we've planned on, in all our estimated taxes and calculations and things like that we've done for our clients, that these PPP expenses are not going to be allowed. So that's kind of the approach that we're taking. Suzanne?
Glenn, I just want to point out, because I know this, this is an area that I know I've gotten questions on, and I think the rest of us have too. And in that previous slide, in your example where the client's taxable income is up to $180,000 instead of $150,000, yes, your taxable income is higher, so you're going to owe the marginal tax rate on that additional $30,000. But in this example, you've also got $30,000 more in cash because you've got the PPP loan proceeds, which are not recognized in here at all, that were in your bank account that were used to pay these expenses. So just keep in mind that for that client in the 2020 column, yes, they've got more taxable income, but they also have more cash to pay the tax. So
that is correct. Yep.
All right, so we're gonna move it back over to Andrew here.
Okay. All right. Well, thank you, Suzanne. So lots and lots of our clients are saying, what's up with my bank? I want to file, and my banker is telling me that I can't.
This is the exact face that we get to.
It is often so so many banks aren't accepting applications yet. And why is that? We've touched on this, I think, in a couple of our other webinars, but there are a lot of things going on. We've touched on it so far in this webinar. A big piece of it is the legislative uncertainty that's going on right now. There's still lots of talk about some kind of automatic or waiver-based, signature-based forgiveness process for loans under a certain amount. The number that keeps getting thrown around out there is loans less than $150,000. And so obviously, if you're the lender, you don't want to start processing forgiveness applications and incurring costs if at some point, in a week or two or a month down the road, these loans are just all automatically forgiven. And so lenders are kind of being hesitant. And, this is a program where we've had rule changes pretty regularly now, ongoing rule changes now for months. And so, lenders are justifiably a little nervous about starting the process until they know they've got some finality. And then, here we are now at September 17th. We're less than 2 months out from the election. It's unlikely, and just in our kind of collective opinion here, for whatever that's worth, it's unlikely I think that we're going to see any major legislative movement between now and the election. And so, banks are, a lot of lenders are just saying, hey, we're going to wait and see what happens. And the Payroll Protection Program Flexibility Act that extended, as Suzanne's noted earlier, the forgiveness applications aren't due until 10 weeks after the covered period ends. And so most borrowers are still in their 24-week covered period. There's 10 months after the covered period ends. And so, I think as as Glenn noted earlier, that puts you in, to June or July of next year. And so there's just not a lot of pressure at the moment on the system to start accepting and processing these applications. And I think everybody, there's a collective desire to kind of see what's going on. It's frustrating for clients because a lot of our clients want to get filed. They've used up their funds. They want to put it behind them, but they can't go. They can't file. Another thing we've noticed, and we've had some clients report back to us, is that some of the bank portals are only giving an option for either 8 or 24 weeks. And we think this is probably a product of how these changes have come down. So the guidance that you could file early comes in the form of an IFR. And it says, it basically just says you can file at any time once during the covered period. Well, there's not a lot of rules about how to exactly, enforce that. And some of the guidance at least appears on its face to be contradictory. If you've got the ability to file early, but you're testing FTEs over a period that extends out to December 31st, how do you handle that? And so I think a lot of, lenders trying to be cautious here and trying not to get their clients in trouble. They're saying, well, if you pick 24 weeks, you got to wait till the 24 weeks is over. And once again, there's not a lot of pressure on the system right now to be pushing these applications through. So we think those are a couple of the reasons why, if you want to file and your lender's telling you that they're not ready, these may be some of the factors at play. And you got to understand too that your lenders are working in the same very changing environment that we are, trying to make these decisions with limited guidance. And it's frustrating, I think, all the way around for all the players. Go ahead,
Sure.
Suzanne.
I don't have anything to add there. We're going to go through one of the questions, we get a lot is, well, if they don't let me file until 24 weeks and I need to lay people off, I have a lot of clients where work is starting to slow down and they need to lay people off. And so do they need to wait until the end of the 24 weeks or, what are their options? So we're going to talk about some of those scenarios coming up here.
Yeah, so let's go there. All right, good. So the next slide. So yeah, so this is a very, once again, trying to kind of hit on the questions that we're getting from you guys, from our audience here and from our clients. This is something we're seeing a lot. So concerns over cuts to compensation and FTEs. And we touched on this a little bit in the last webinar, but we're going to revisit again just because we continue to get questions on this. So as the forgiveness process continues to get delayed, a lot of our borrowers, a lot of our clients are asking about the impact and reductions to FTEs. And why? So why are they asking this? Why are people concerned about this? Well, one of the FTE safe harbors, that's safe harbor number 2, provides that FTEs must be restored by no later than either December 31st, 2020, or the date the borrower files its forgiveness application. So this goes back to the guidance and the rules that you can file early, right? And this seems to support that. But if your forgiveness application is being delayed, then that seems to be pushing back the date that you can make changes to your FTEs. In other words, the number of people you have working. And so, you know, borrowers who are working under the expectation that they could file early, they could cut everything off, and then go ahead and start addressing some of the business impacts that they're feeling in their day-to-day operations, are now worried, well, if I cut people at this stage, am I going to be reducing the amount of forgiveness I'm eligible for? And so if you can't file, does this mean you have to keep everybody on payroll, even if you've used up, in quotes, all your PPP loan proceeds? So Suzanne, let's go to the next slide. So should you be concerned? You know,
Jerry's concerned.
Yeah, Jerry is clearly concerned. So should we be concerned as borrowers? And so, you know, first of all, in practice, these reductions appear to be impacting a very small number of borrowers. And so why is that? These are things we've talked about before in the past. One is the salary and hourly wage reduction thresholds must exceed 25%, and they only include earners making less than $100,000 a year. So, you know, this is, so just to kind of put this approach, remember when we talk about salary and hourly wage reductions, we're talking about the rate of pay. We're talking about, you know, actual dollar wages. So taking somebody from $10 an hour to $7.50 an hour, or taking somebody from $100,000 a year to $75,000 a year or less. You know, there are other exemptions for people making, you know, $100,000 a year or less, and so, you know, keep in mind that somebody that makes 100,000, somebody that earns at a rate of pay that exceeds $100,000 a year for any given pay period is also excluded from these calculations. So, you know, if our friend Jerry here is, you know, maybe he normally makes $750 a week, which works out to about $40,000 a year, but he gets a quarterly performance bonus that is, you know, $5,000 or $6,000 or $10,000. Well, even with that quarterly bonus, he's still making less than $100,000 a year, but his rate of pay for that pay period would be in excess of $100,000 a year if you annualized it. And so Jerry comes out of the calculation. We're not going to worry about him. The exemptions and safe harbors, we've talked about some of these, but these are going to be the exemptions for things like you get to exclude positions where you've made good faith written offers to rehire if somebody quit, or you had an involuntary, you had voluntary resignations or those kind of positions. You've also got the safe harbor for employers who are unable to return to the same level of business, or if you've actually been able to restore your FTEs by the end of the 24 weeks or the date you file your forgiveness application. But even then, we've still got clients who are worried about this question. So Suzanne, Glenn or Suzanne, anything you want to add there before we go to the next slide and look at a couple quick examples?
Nothing to add here.
All right, so let's just take, if you've been in our webinars, you know we love our hypotheticals. So let's take Bake My Day. Bake My Day is a cupcake company in the mall, it looks like, but behind the scenes, they're dealing in a lot of contraband, like the Times Square Jumbotron or the Statue of Liberty, the small one from Las Vegas, shrink rays, the moon, that sort of thing. So let's look at Bake My Day here. So Suzanne, next slide. All right, so Bake My Day got $500,000 funded on May 1st.
Those minions, they make a lot of money.
They do, yes. And there's a bunch of them. It's not that
there are a lot of minions.
Yeah, but there are a lot of them. So $500,000 PPP loan funded on May 1st. They had some reductions in staffing, but by week 12, they've used up all their PPP funds and are ready to file. But Mr. Perkins won't let them. The portal's not open yet. He's holding out, see what Treasury does. And so they can't file. Now, management's worried that they need to start cutting staff. Business is slowing down. Cupcakes aren't moving quite as much. People can't eat them when they're wearing masks. And so They want to slow down, but they're worried about the impact of this FTE reduction quotient. So Suzanne, next slide.
Stewart's head is on the blocks.
Yes. So so this is a couple examples of how the FTE reduction quotient works. So if let's say at week 12, Bake My Day had $500,000 in eligible payroll that they'd incurred. They had $50,000 in other costs, and they had experienced a 25% reduction in FTEs. If they have restored the FTEs by the end of week 12, then they're okay. They satisfy that safe harbor number 2. If they can't restore their FTEs by week 12, then they're going to have a reduction. And we're going to assume here that they weren't eligible for the safe harbor based on a reduction in based on CDC regs or HHS regs, because presumably criminal enterprises don't follow the OSHA or CDC. But let's look at week 12 with a safe harbor. If you meet the safe harbor standard, so even though they've had a reduction in payroll, they meet the safe harbor. So line 7, the FTE reduction quotient, you get to stick a 1 in there. Even though you had a reduction, you rehired people before you filed for forgiveness, and so you're good. And so $550,000 in total cost, $500,000 PPP loan amount, you get to forgive the entire thing. If you don't meet the safe harbor, you'll see then your line 7 FTE reduction quotient is 0.75. You multiply 550 times 0.75 and you get to 412,500. That becomes your limiting factor because you're entitled to the smallest of lines 7, 8, or 9 on your application. And so Bake My Day would only get $412,500 in forgiveness. That means they would have to repay $87,500. So that's if they filed at week 12. What happens if they get to extend that period? And so Suzanne, the next page. So this kind of gives us an idea then of what happens if they just wait out the entire 24 weeks. So even with a 25% FTE reduction, if Bake My Day waits out the entire 24 weeks, they get to a total payroll and non-payroll cost of $825,000. Now it's $825,000. You still multiply it by the same 0.75. But now your line 8 total is $618,750. And once again, your forgiveness is the less of line 8, 9, or 10. And so $500,000, which is your PPP loan amount, is the smallest number there. And so you get full forgiveness. You get to forgive the entire $500,000. You don't have to repay anything. So here's an example of how simply holding on, simply waiting out the entire 24-week period, letting your payroll accrue, you would have enough payroll to meet your to get full forgiveness. And in this example, we don't show this here, but you could even remove the other eligible payroll expenses. And even with $725,000 in payroll, Bake My Day is still going to be able to achieve full forgiveness, even with the FTE reduction quotient. So our advice here is that if you need to reduce your staffing count and you are unable at this point to file for forgiveness, first of all, make the right business decision. Don't hold on to people that you don't need just in order to achieve forgiveness, at some point 10 weeks or a year from now. Second of all, you may not have the problem you think you have. Get with your CPA, call us, get with somebody who can help you with these calculations, run the numbers, because you may be able to make your needed staff reductions. If that's what you're facing because of the market, you may be able to make these staff reductions and still achieve full forgiveness. So Suzanne and Glenn, I think it's back over to Glenn here.
Yep, we're going to talk about the hot topic of payroll taxes.
Yeah, so this is a really hot topic. Back in August, President Trump signed an executive order, declaring that employees could defer their Social Security taxes. That's the 6.2% of their payroll, for the rest of the year, from between September 1st and December 31st. So, as GRU is in disguise here, so is this deferral. It is a nightmare in disguise for employers. So the eligible employees that make less than $4,000 biweekly are eligible. And the money is paid back between January 1st and April 30th. And it is paid back by basically, during that time period, doubling the employee's withholding on Social Security. So instead of 6.2, then the employers would be holding 12.4%. So certainly that means, less money, in the future, which, once again, this is a repayment. This is not a forgiveness. We've had a lot of questions about that, and the president doesn't have the ability to do forgiveness. So this is a deferral. Not saying that Congress won't change it to forgiveness, but it is a deferral. But here's the problem for all employers. The employers take all the risk, they accept all the responsibility if the employee quits. So, what if their last paycheck isn't enough to carry their, repayment? Well, then you got to make other arrangements with an ex-employee to get money from them. That's not very likely to happen. So luckily, the employer has the option to offer this to employees. It is not mandatory. So if an employee comes to you and says, hey, I want to defer my payroll taxes, you can tell them we are not offering that option. So that was one of the good things that came out of this. And the AICPA call that we had, basically no one is taking advantage of this from an employer side. Employers don't like it, and they shouldn't like it. It's a bad deal for them, because they accept all the risk and have all the responsibility. So if you're out there, if you've thought about it or still thinking about it, our advice is to not go down this path. It really doesn't do you any good. The time frame is so short that the benefit is minimal, to employees, and it's just a headache, to go and reconcile that as well. I haven't had a single one of the big providers, ADP, Paychex, any of them, send out something that says this is how we're going to do it. So I don't think they're encouraging it either. They don't want they don't have the ability to track it probably. But once again, I mean, this just goes back into an employee loan, essentially, is what you're giving them.
Yeah, I just got an email this morning from a payroll provider that said they're still working on rolling this out and getting it to actually happen. So even though we're on the 17th of September and this was supposed to start September 1st, I think a lot of people are still scrambling to get this in the works. So if you didn't make a decision yet, we don't think it's too late, but we also don't think you should do it.
Yeah, I was just going to point out too that I think what we're finding and what we're seeing from our clients and what we're seeing ourselves, to be honestly, is that when you sit down with your people, I know there are some clients out there that have felt some pressure to do something because their employees have heard about it. Maybe their employees are asking, or their employees are asking managers, or are we going to do this? This is going to be available to us. When you sit down and walk your team through it, your employees through it, they usually can say, well, this isn't that great a deal anyway, so why bother? And especially when it becomes clear that look, you're going to have to repay this. This is just, you're just pushing this relatively small money out 3 or 4 months, and then it's going to come back down at the end of the road. So we're at least in my experience, most employers are able to, if they're choosing not to do this, they're able to have this conversation with their employees, and their employees are getting on board with it. They understand what's going on.
All right, so we do have a couple questions here at the end, and if you have any, if you're listening and have some questions, please put them into the chat and we can address them as well. But these are some of the frequently asked questions, as well as a few registrants. When they registered, they put this in their registration as a question. So we're just going to roll through a few of them. We've got a couple minutes, so that's great. We understand this question is probably on every webinar we've had so far, but we continue to get it. So we're going to re-up the answer here. Glenn, are there any specific guidance for sole proprietors? Can you tell us?
Yeah, so compensation, once again, is limited to 20,833. So if you filed a Schedule C, you made, $100,000 or more last year, then your limit on forgiveness and your loan limit should have been 20,833, unless you had employees. So if you had employees, obviously they're not subject to the same limit. We definitely think this is going to be taxable income. And we can't include any 401k contributions or health insurance costs in the quote unquote payroll number. So it's strictly your Schedule C income from last year, not to exceed 100,000, multiplied by 2.5 12s. If you've got multiple businesses, you really have to allocate that capped amount, that 20,833, over the different businesses. Just because you have 5 businesses doesn't mean you get 20,833 5 times. So, the other thing is that your cap, if for some reason you only used 8 weeks, the cap goes down to 15,385. So you want to make sure that you definitely go the 24-week route here. Make sure you get full forgiveness, because for Schedule Cs, that's really the only way you're gonna be able to, unless you have other costs.
All right. Next question. Can we submit our application directly to the SBA and just not go through the bank at all? Glenn?
Nope, no banana, no party. You must file with your bank. So if you've got a buddy at the SBA that can fast track it and say he's going to do it, nope, you can't do it. You got to go through the bank. They got to go through their approval process, and then the SBA approves it. Because remember, the SBA is paying your loan to the bank. It is not paying it to you and then you pay the bank. So once your application is filed, it's kind of all out of your hands.
All right, Andrew, can you help us on this one? You are our form and line item man. So can you explain line 7 on the 3508 EZ? We got some math here.
They keep giving the non-account at the math questions. I don't know why that is. No, this question comes up a lot. It creates some confusion. It's line 7 on 3508 EZ. It's line 10 on the regular 3508 full application form. It says divide the amount on line 1 by 0.06 and or 0.60 and enter the amount. So you got to remember, the purpose of this calculation is to test or to apply the statutory limit test that was added as part of the Payroll Protection Program Flexibility Act. And that statutory test is that your payroll cost cannot exceed or your payroll must equal or exceed 60% of your total forgiveness amount. So this is how this calculation gets figured. And so let's just take a couple scenarios real quick. We love our scenarios here at Salt Marsh. So let's take a borrower that has a PPP loan of $100,000. Under the first scenario, their total payroll cost for the entire 24 weeks comes to $300,000. 300,000 divided by 0.6 is 500,000. That's the amount that goes on line 7. And then remember, what you're looking at is you're looking at the smallest of lines 5, 6, or 7. So that $500,000 is well in excess of your $100,000 PPP loan amount. You're going to achieve full forgiveness in that case. Under scenario 2, somehow the borrower's total payroll cost for the 24-week period only comes to $50,000. $50,000 divided by 0.6 is 83,833. That amount goes on line 7. And now you likely have a situation where even if you have other costs that are increasing the amount on line 5, you may have a situation where your forgiveness is going to be limited to no more than $83,333. And so once again, the purpose of this is to apply the statutory test. As a practical matter, this calculation was really important for 8-week filers, as we've demonstrated on, in previous calculations. For most borrowers, the vast majority of borrowers who are in a 24-week covered period now, you're not going to have any problem at all passing this test. You're going to have way more payroll than you have a PPP loan, and this test is not going to be an issue for most people.
Yeah, I think the operative word in your sentence there is in that second bullet point is may. It may limit your forgiveness, because most likely if you've fallen under this scenario where you haven't been able to pay enough payroll in 24 weeks, that you've got an OSHA exception or something like that, that is, you're going to get forgiveness another way. So that's something to keep in mind, is just because you don't get it in this, there are other ways.
I mean, so yeah, exactly, Glenn. I mean, think about that. That means that original $100,000 amount was based on 2.5 times your average monthly payroll from 2019. If you've only spent $50,000 in payroll over roughly over 6 months, you've had a dramatic reduction in your workforce. And so you are probably in an industry where you're getting that blanket exception that you've had to make reductions based on, OSHA, CDC, or HHS guidance, and you're probably exempt from all those anyway, so it doesn't matter. So that's a great point, Glenn. Thanks for making that.
All right. Well, we are running up on the 4 o'clock hour. I don't know if Jamie is still hanging out in her truck. There she is.
Yeah, so just to close, thank you, Suzanne, Andrew, Glenn, for being here with us again. Lots of great information. I'm getting lots of requests for the slide deck. And so for those of you who are looking for this information to reference, know that we'll email it to you along with a copy of today's recording. So you'll get that by email. We didn't see many questions come through, so if you have any that you think of after the fact, please feel free to email them to us at ppp@saltmarshcpa.com. And remember that we are here to help you through this process. We are in part 7 of our webinar series. I think I smell an 8th one coming. I'm sure we'll have more as details continue to come through. But if you do need anything in terms of your application and getting that approval and forgiveness, obviously, process going, let us know. We'd be happy to help you. If it's just a matter of answering questions, we're always happy to do that. And we're also able to do full preparation of those applications as well. So keep our team in mind. Let us know if we can help you at all. Thank you for being with us again today, and we'll keep you posted on the next one. Thanks to our team, and we'll see you next time.
Stay safe, everyone.